All right, welcome back to another edition of Financial Accounting. Today is Thursday, February 18th. It's cold outside. We are going to record today's lecture 5.1, 5.2 for all of you who may or may not have internet access tomorrow. We're going to go ahead and cancel class, live class tomorrow. This will be recorded. So use this recording to help you fill out the class notes that I posted up on Blackboard. 5.1 and 5.2, you will see, are in the Chapter 5 folder. There they are, 5.1, 5.2. So make sure that you have these notes downloaded and ready to fill in. We will jump into these in a second here, just to make sure everyone is good to go with what's going on this week. The winter storm has caused a lot of disruption. So we're pushing forward 5.1, 5.2 for Friday. On Monday, we will have a live class, 5.3, 5.4. Those notes will be updated over the weekend and put up on Blackboard. Make sure that you know that homework for 4.4 and 4.5 has been pushed to Sunday. Our exam is going to be Wednesday, February 24th. So that's a little less than a week from today. So hopefully you all read the email about this being pushed to next Wednesday. Realize the downside of making these adjustments is we're going to have a lot of homework due back to back to back. So the day after the day after our exam, make sure that you have 5.1 and 5.2 homework done. So I'm giving you roughly a week to jump in on that. Once that homework is posted up on my accounting lab, I will let you know. So when this lecture is over with, I recommend going up and working on the homework that's on my accounting lab. 5.1, 5.2, no chapter material. Exam 2 is only about chapters 3 and chapter 4. So, and remember, by 4, I mean 4.4 and 4.5. No chapter 5 material or 6 material is on the second exam. So the exam is still only covering those two chapters. We're just pushing forward the material, the lecture material for chapter 5. So when we come back and everything gets normalized, we will just continue on as expected. Homework 5.3 and 5.4 will be set up and due Sunday, February 28th. So a lot of changes going on. Hopefully you read the email I sent out, I believe it was yesterday, on the 17th. If you have any questions, of course, about these schedule changes, let me know. So right now we're going to be lecturing about this. The homework for that will be due the following week after the exam date. So don't ease off the pedal just because we finish an exam. We have to jump right back into things. Also realize there's no class next Friday, February 26th. So hopefully that'll give you some time to rest and recuperate from this crazy week and get caught up with everything. But we need to move forward. There's a lot of work we have left ahead of us here. So we're working on chapters 5.1 and 5.2. Tentative schedule has been updated in the course administration folder, so make sure you take a look at that if you need any further clarification. Chapter 5 talks about receivables and revenue recognition. So we're kind of moving now. So we started talking about, was it chapters 1 through 3? We're sort of talking about accounting overall. So we're talking about the income statement, we're talking about the statement of retained earnings, we're talking about accrual accounting, the balance sheet. We're given a handful of transactions, et cetera, et cetera. Now what we're going to do going forward here is we're going to start focusing on specific accounts within the balance sheet. So the balance sheet, and I recommend, as I said, from first couple lectures of the class, I recommend you kind of create sort of a study guide where you list off all the different asset accounts you come across as you're reading your textbook. So assets, liabilities, stockholders' equity, and then the income statement accounts. So the various revenue items that you see and the myriad of expense accounts that you come across. Make lists of these things as you're reading your books to keep these accounts straight in your head. Chapter 4, we talked about cash. That was chapter 4. Now we're going into chapter 5. We're going to talk about accounts receivable. Chapter 6, we'll talk about inventory and its various special topics. I believe chapter 7 is also included in that. So hopefully you realize now we're diving in. We're diving into the individual accounts that we see in the assets, liabilities, and equity accounts. So Chapter 5 is all about receivables, but we can't talk about receivables without talking about the revenue recognition principle. The revenue recognition principle says we recognize revenue when it's earned. But what does that really mean? I mean, a lot of people can have their own sort of definitions about what it means to recognize revenue or what earned means. Essentially, the seller has done everything required to earn the money, and everything required is usually specified in the contract. Usually, it's explicit, but it's oftentimes implied. What it means when I say do everything that's required, if the contract requires that goods be delivered, then essentially the money has been earned when the goods have been transferred to the customer and the customer has assumed ownership. Just because we hand off a bunch of goods to a customer doesn't mean that they necessarily are going to be accepted. So it's kind of two components. One, we are transferring ownership, and that ownership is being recognized and assumed by the recipient. If we perform services, realize if we're cutting somebody's hair and they don't like the services we provided, the question comes down to whether or not we substantially completed the service. In other words, did we give them a satisfactory haircut, even though it may not be exactly what they want? Usually, it's more of a kind of a legal question at that point. But essentially, the key here is substantially completed. We did the work. Therefore, we have earned the revenue. Whether or not they pay us is a matter for the courts to deal with if worse comes to worse. How much are we going to record? Well, it's essentially going to be based on the cash received or the fair market value of the assets exchanged um, and the cash received from that. So, generally speaking, when you have a transaction, you buy coffee, you pay cash for that coffee. That's the fair market value of that cup of coffee. Recognition criteria. There's actually specific criteria that's set up by the FASB. Remember, the FASB, Financial Accounting Standards Board, is the one that comes up with the rules that says this is what it means when revenue has been earned. So these are kind of technical things, but just sort of realize that all of these revenue criteria are based on what's stipulated in a contract. Here's what I agree to do in exchange for money. Did I do them? Yes or no? Usually the contract, if it's very explicit, it's going to be pretty clear whether or not it has been those things have been done. Written or oral, oftentimes things being written down is usually the case, but oral contracts, if you're taking, excuse me, if you're taking B law, hopefully you realize by now that oral contracts are also valid contracts. Generally speaking, a contract is an agreement between two parties, creates enforceable rights or performance obligations. Recognition steps. So what do we go through to determine whether or not revenue has been recognized? Well, we identify the contract. There better be some sort of explicit exchange of promises. Identify the performance obligation. What do I need to do? What do you need to do? Determine the transaction price, generally based on the fair market value, based on the amounts that either if I'm paying, the price is going to be stipulated in the contract, or if the customer's paying, that will be stipulated one way or the other. When you go to McDonald's or Starbucks, those prices are quoted up on the boards. That's how you determine the transaction price. This is kind of strange. Allocate the transaction price to specific performance obligations. This is a situation where we have, like, say, a percentage of completion. Maybe we start off by doing 10% of the work, right? So total work we've done is, say, 10%. Then on another future date, we do another 40% of the work. So that means now we have done a total of 50% of the work. Then we do the other 50% at a later date, and that means a whole 100% has been completed. So if we have to spread out the performance of a building, you have to construct a building, usually that thing is not going to be done in a day. It's going to be done over maybe a couple years. So we may have to separate out how the price is earned based on a certain percentage of completion. Excuse me, it's very cold outside. I'm sort of choked up here. Recognize revenue when the entity satisfies its obligations, and usually that's pretty obvious and straightforward. Um, don't worry about making that determination in this class. I will just either tell you or that will be pretty obvious in the problems I give you. So, record a sales transaction. When do we record a sales transaction? When we have earned the money, when we recognize revenue when it has been earned. So, a sales transaction, we hear the word sales, think sales revenue. It's different now than what we saw before. Before we saw service revenue. This is sales revenue. We're actually delivering goods in this case. And the types of goods that we're charging and selling people are going to be smartphones. So let's assume that we, the company, deliver 30,000 smartphones to a customer, a retail outlet. The price we charge the retailer is $100, and let's say we sold it on the account. So we're going to bill them, they're going to pay us cash later. The cost per the phone is $60. This is our cost basis. Why are we charging a higher price? Because we need to make money, right? We want to lower our costs and increase our prices to make money. Okay, so our cost basis, whatever it took to either build the phones or buy the phones, that's how much each phone costs on our inventory. We're going to sell them for $100 or a $40 markup over the cost. How do we record this transaction? The key thing to realize in the sales transactions is that we need to record two journal entries when we're recording a sales transaction. So this is a bit of an extension to what we've seen before. Generally, when we sell an account, we're going to debit accounts receivable because we're not collecting cash right away. We're going to get cash later. So right now, the retail customer is going to owe us how much money? Well, it's $100 per phone times 30,000 phones. So they're going to have to owe us $3 million. In this case, we're still going to record revenue, but we're going to call it sales revenue, implying that we sold some type of goods. Service revenue is when we perform services. Sales revenue is when we earn sales. We really don't differ too much beyond that in this class. Sales are for goods, services are for service. Record the 3 million. Now, here's the second journal entry. When I say record two journal entries, here's the second one. This is very key. We need to record the reduction of inventory based on the cost. The cost per unit was $60. So if you sort of think about it, in our inventory account, we have this asset worth, let's see here. Oh, how much do we have? Let's just say we sold the whole lot. So let's just say we have $1.8 million or 30,000 phones in our inventory. If we're going to sell all these, we need to reduce or credit the asset account to say, to represent the fact that we sold that inventory, bringing our inventory down to zero. So inventory is currently on our books. We have an asset of 1.8 million, and assume we paid cash for that. We bought it. Now that we have it, the question is, what are we doing with it? We're selling it. We're giving this value. This is how much it costs on our books. That represents cost of goods sold, which is an expense. We're going to debit this account called cost of goods sold to represent the expense, the consumption. Cost of goods sold is the consumption of an asset, or consumption of inventory in this case, which we talk about next. So we're recording two journal entries. One is for the revenue and one is for the expense, which we call cost of goods sold. So down below, note that the cost of goods sold, or COGS, is an expense, which represents the inventory asset that's being consumed. So we use cash. When we use cash to pay for salaries, salaries expense represents cash being consumed. If we pay for utilities and we have utilities expense represents cash being consumed. When we see cost of goods sold, that represents the inventory assets being consumed. So in this case, we've already spent the cash for that inventory. Now we're basically just saying we're going to get rid of that inventory. So down below, we want to, whatever the inventory balance is, we want to credit that, reduce that down by 1.8 and show cost of goods sold, the expense account. There's the debit of $1.8 million. We also are going to record the debit to accounts receivable and the credit to cash in this case. So remember, there are two journal entries in this case. We have two journal entries when we sell goods. Later, say 20 days later, after the sale and account, we get the cash from the customer. Customer sends us the money. Thanks, these phones seem to be working all right. We just simply debit cash, debits make us happy, and we go ahead and reduce the accounts receivable because they have paid off what they owe us. So all we're doing is we're just converting one asset into cash. Credit the accounts receivable, put it into cash. This is a perfect world, assuming that all the phones work perfectly and that there are no issues trying to collect on the amounts that our customer owed us. We don't live in a perfect world, but this is a perfect world example. Let's take a closer look. Did we actually earn the $3 million? Well, the first step says identify the contract. And the contract was that we give the phones, we get the money, or at least a promise to receive money. Identify the performance obligations. Well, our performance obligation was to deliver the phones, presumably in good condition, to the customer's warehouse. Okay, maybe we set up to where the customer brings over their delivery truck. We can load that up, but generally speaking, we deliver the phones in good condition. That's fundamentally implied. Determine the transaction price, $100 per phone. That's the price, not the cost. Allocate the price to the performance obligations. Well, we're obligated to deliver phones, and that means on each phone is going to be $100. So it's $100 per phone that has been delivered. So if we only deliver half the phones, we only recognize half of the revenue. In this case, if we deliver all the phones in good condition, we'll recognize the full $100 per the 30,000 phones. Recognize revenue when the entity satisfies obligation. It really sort of depends on the shipping terms. So I could have talked about that a second ago. It's like, when have we essentially completed this process or satisfied our obligation? Well, the customer has to get the goods. So when does this actually happen? When does the customer actually get them? Here's a key concept here, and this is important to remember. There are shipping terms called free on board, FOB. It's an old school term that gives us an indication contractually when the performance obligation is satisfied. And specifically, free on board implies when the title to the goods transfers from the company to the customer. So in scenario A, imagine that the terms are FOB shipping point. There's really only two types here, shipping point and destination point. If I'm shipping these goods, FOB shipping point, it means the title transfers at the company's shipping dock. So if this is my company right here, these are all my different shipping bays, right? And if it's a shipping point, assume that the customer sent over their truck, and we loaded all the phones onto the truck, and the customer drives away. This is the customer taking away the goods. It's when we transfer onto all of the phones onto their truck from our shipping dock. That's when we can say we have recognized the revenue at this point. So the company is basically saying, come and get it. It's a shipping point. So bring over a truck or call UPS. It's usually the buyer, it's only at the buyer's expense. Buyer has to pay for the shipping in this case. We're just saying, once it's on your truck, it's your problem, not mine. So in the case of a shipping point, FOB shipping, the sales recorded when the company at the company shipping dock when the goods leave the seller's place of business. The other alternative, and this is really the only other one you need to pay attention to, is when it's free on board destination point. We're transferring title from the company to the customer based on where the point where these phones are going to end up, which is in this case, the destination is at the customer's receiving dock or receiving bay. So the customer's like, hey, dude, bring it over. So in this case, assume it's our truck. Our truck, we're bringing it over. We offload it into the customer's receiving bay. Once all of those phones have been offloaded off of our truck and been received by the customer, the warehouse manager in this case, customer's receiving dock is when the title transfers. Therefore, when the customer receives the goods, that's when we can say, okay, record the sale. And usually there's some sort of electronic device that goes beep and says, okay, we can now, the title is transferred, they've accepted the goods, we can recognize the revenue. Some other concerns when in terms of selling on account, because realize we're trusting people to pay us back at some point in the future. Right now, all I want you guys to think about is it's a perfect world where we will get all of our money. We'll talk about later when we have to worry about making an estimate for the amount we might not collect from certain deadbeat customers. But for right now, assume that we will get all the cash. But in the example we saw above, it took the customer to pay us 20 days. 20 days is a long time in business. Is there any way for us to collect the cash sooner than 20 days? There are strategies. And we'll talk about these one at a time. The discounts, we can offer sales discounts for early payments. So if you pay us within 10 days, you can knock off like say 1 or 2% off the amount you owe us. We'll talk about that when we objective 5.3. So let's talk about these other three ones down here. The credit card is the number one way that small businesses try to collect sooner than later. Generally speaking, a business doesn't trust customers it doesn't know about. So that's why we have credit cards established. But credit cards cost money, so this is a very important concept to keep in mind here. Company collects sooner by emphasizing credit card or bank card sales, right? We also would like to get cash up front, but if the customer doesn't have cash, then we must emphasize that they use a credit card. Don't take this whole, hey, I'll pay you back later, bro. Yeah, this is business. Sorry, bro, but you need to either bring cash or use a credit card. So imagine how credit cards work here. Credit card companies operate on a fee-based system. So if we're a credit card company, or excuse me, if we are the seller and we're contemplating whether or not we want to accept a customer's credit card, we have two options. Either we pay 2% to get full collection right now from, say, a Visa credit card company. Okay. That's our option. Allow somebody to use their Visa credit card company, and in which case we will have to pay 2% based on the sales amount. But that will guarantee 100% collection right away. The other option, though, of course, is to just take the customer's word for it. Pay zero fees and hope that our customer will pay us the full amount later. Generally speaking, this is where a lot of small businesses get into trouble. So you want to kind of like really consider whether or not how well you know your customers in this case. But why would we want to accept? Why would we want to give up 2% of our revenue um, when we can just give up zero fees for collection from the customer directly? Why would we want to go through a third party intermediary? Well, think about it like this. If a company historically writes off, meaning has to accept no payment, right? Someone promises to pay us, but they don't pay us, right? This is bad news, but this is the real world. If a company historically has to write off, accept no payment from customers, say 5% roughly of accounts receivable, and that's a situation where we're basically saying, when we look at our accounts receivable, we assume that 5% won't be collected from people because they'll go into bankruptcy or they'll just skip town or whatever. That happens, and that's unfortunate. But that's historically what we see, what we have to write off um, as non-collection from our receivables. It may be worth it to pay, say, $60,000 to Visa to guarantee collection of the full $3 million. We'll talk about how this math plays off. And the reason why that makes sense is because 5%, if we sold $3 million worth of goods on account, but we expect not to collect 5% of the money, remember, accepting no payment. If we have to write off 5% of that 3 million, that means we're going to lose out on collecting $150,000 on this particular sale. So does it make sense to go through a credit card company? It does in this case. I'll gladly pay a 2% fee to the credit card company to guarantee me some collection of this 3 million. Again, we'll talk about that in a second. But if historically we don't write off, and let's say we have really good customers, maybe only 1% of our receivables become bad debts, right? We have really good customers that pay us. In that case, it makes more sense to say, hey, I'm willing to give up 1% of $3 million if it means I collect from my customers directly. If I take their word for it, I might lose out on $30,000, but I'm willing to take that chance. If I accept a credit card, I'm definitely going to have to pay the credit card company $60,000 just to get the money right now. So these are sort of the decisions that companies make when they're trying to determine whether or not to accept credit cards. But I just kind of want to give you this broad perspective as to why we need to worry about doing the accounting for credit card collections. So here's what you need to pay attention to is the actual journal entries. Okay, so let's assume that we accept credit cards from the customer. Customer uses the credit card to purchase. company accepts the credit card, and it acknowledges that there's going to be a 2% fee that needs to be held back by the credit card company. Okay. So when a sale is made, granted, we are still going to credit sales revenue for the full $3 million. But what do we actually expect to collect in this case? We expect to collect as a receivable, not from the customer, but from Visa Credit Card Company. We expect to collect $2.94 million from the Visa company. Why not the full $3 million? Because Visa is going to hold back their 3% fee. This is the 2% fee. This is the 2% fee that they withhold. So if Visa is the company, right, the customer will eventually have to pay Visa $3 million because the customer is using Visa as a credit card company. Visa will automatically give me, regardless of when that $3 million is paid by the customer, Visa will give me $2.94 million to me, like usually within a 24-hour period. That's a pretty good turnaround time. But the Visa gets to keep their 2% fee from that amount. So overall, what's happening is Visa is just an intermediary, like a settling agent that guarantees the collection of cash on my side, but they're charging me as the acceptor of the Visa transaction. They're charging me the fee of $60,000. So they're going to keep that. Eventually, they'll collect $3 million total. So if you think about it, if you're Visa, right? Right now, there's their cash out to me. They're going to pay out $2.94 million, right? Later, they'll get cash in from customer of 3.00 million. Okay. So if you think about it, they're paying out 2.9, but they eventually get in 3 million. They get to keep $60,000 cash, 60K cash overall. That's how Visa makes money. That's the reason why they're willing to be in this business. Plus, it's possible that if the customer pays, takes too much time to pay, Visa will charge a late fee for trying to collect from its user. But in our case, maybe it's worth accepting the credit card just to guarantee collection of $2.94 million later. Next morning, let's assume within 24-hour period, Visa automatically deposits 2.94 million debit cash credit accounts receivable from Visa 2.9. Again, this is a good thing because we may have only collected essentially what this represents is 98% of the sales revenue, right? We earned $3 million, but what we actually got in cash was 98% of that. And in other words, we willingly gave up 2% of our sales to guarantee cash collection from this transaction. Remember, option B is to simply sit back and wait for the customer to pay us the full $3 million later. That may or may not happen. The question is whether or not we're willing to take that risk. So that's a key thing to understand about the credit cards because it's a real thing in business. We can also charge interest after a certain time period. So let's say we don't use this. Let's just say we trust our customers. We trust our customers to pay us in full. Okay, so we're not going to use credit cards, but what we'll do is we'll say, hey, look, pay me back later. Okay, but if you take too much time paying me, I'm going to start charging you interest. Okay, so in this case, assume that we the company does not use a credit card company, opts to wait for the customer's payment. 30 days later, still haven't collected the cash. I'm getting a little antsy, so I'm going to go ahead and charge, and my customer knows this too. I'm going to charge this 0.5% late fee on the $3 million balance that's still outstanding. Customer knows this in advance. Maybe they're deliberately taking their time to pay us for whatever reason. But in this case, we're going to add another $15,000 to their already $3 million account. So imagine they have accounts receivable of $3 million. Tick tock, tick tock. 30 days goes by. I'm going to tack on another $15,000 that they owe us because that $15,000 represents a late fee. So what I should expect to get after 30 days is not just 3 million. I should expect to get $3,015,000. And again, I would set this arrangement up with them. So because usually when you set up an accounts receivable with a customer, it's usually done with certain credit terms. Alternatively, you can opt for a more effective credit collection procedure. We can talk a little bit more about factoring our receivables. Obviously, you don't want to call it the Sopranos and have somebody break someone else's kneecaps. That's not legal. But we can talk more about some other types of collection procedures later on. Let's move into 5.2, talking about sales, refunds, returns, and allowances. In 5.1, the perfect world was that the goods we sold on account were shipped and they were all worked perfectly. We had no issues, 30,000 phones, and they all work perfectly. Is that realistic? Maybe, maybe not. But in a realistic world, there may be some phones that don't work, in which case we would have to offer a refund to our customer or give them the right to return the goods or give them some sort of allowance on the accounts receivable that they owe us, like just some sort of benefit to them, sort of say, sorry, don't worry about paying us a certain amount. It's the customer's right to return unsatisfactory or damaged goods, and that's protected by the Uniform Commercial Code. But it's also fundamentally based on contract law. So just realize any goods that are not satisfactory or damaged, those are going to be returned, or at least the seller, in this case, if we're the seller, we owe them some sort of compensation for bad goods. Assume the customer accepts the phones it purchased, but later customer sends a notification that 300 phones were jacked up, they're inoperable, or they're damaged. Okay, that's roughly what? What's 300 of 30,000 phones? You need to do that math real quick. Start chopping off the zeros. So click, click, 3, chop off 2 zeros above, chop 2 zeros below, 300. Okay, that comes divide 1 over 100. So that's what's 1 divided by 100? That's just 1%. That's pretty good, I think. On 30,000 phones, you got 1% that somehow there's an issue with them, it's just not working. We can just tell the customer, hey, look, we're going to issue you what's called a credit memo. Okay. And the credit memo, the term credit memo, I'm going to credit your account. I'm like, tell the customer, look, don't worry about that. I'm going to credit your account. Someone follows along with our debits and credits in accounting. So the use of debits and credits in the real world sometimes follows to some extent how we do debits and credits in accounting. But for right now, just realize a credit memo means we need to, in their accounts receivable, give them a credit to offset whatever balances they owe on the debit side. So the credit memo is going to be, for this case, $30,000. The 300 phones times 100, that's the price, PX price. We're going to give them a credit of $30,000 and basically tell them they don't owe us $30,000. So this is how it looks down below. I tell them I'm going to issue them, I'm going to credit their account and send them documentation that says legally you don't owe us this money. So I'm going to credit their accounts receivable. I'm going to reduce their accounts receivable for the $30,000. What do I debit? This is the confusing part that some people come into on an exam. Well, if there's any type of bad goods that were sent out and revenue was recorded, we're not going to debit the sales revenue. We're going to debit this other account called sales refunds, returns, and allowances, or some people just call it sales returns and allowances, or sales RRNA. Sales RRNA. Sales RRNA is a contra revenue account. Revenues typically have a credit balance, so this has a normal debit balance. This is meant to offset whatever revenue we have earned. So in this case, from up above, what you see when we post it is there's the accounts receivable, there's the original 3 million that they owe us. And what we're saying is we're going to reduce that amount by 30,000. We're not going to debit sales revenue. We're going to leave sales revenue alone. Sales revenue shows $3 million. Leave that there. Create an offsetting $30,000 debit in the sales RRNA account, and this essentially, these two offset each other. So down below, the way we look at it is on the income statement side, we see sales revenue, $3 million. And then we see this thing called less sales refunds, returns, and allowances of 30,000. The net sales, given that 30,000 or 300 units were defective, the net sales represents essentially what? That's 30,000 units minus 300 units that were returned to us means there was 29,700 units kept by the customer. Okay, 29,700 units times $100 price per unit is how much? 2,970. So the point of the matter is we may have made a sale of $3 million, but the net sales revenue represents the true amount of revenue that we are recognizing from this particular transaction. Sales revenue is just an account. We're just keeping track of returns in a separate account. And why would we do that? Well, if I'm a manager, I might want to have a separate account that I can look at to see if I'm selling any bad goods. I may have to go back to the manufacturer, or maybe I am the manufacturer. I may need to go back and change my processes. In the so sometimes you also see this. I just put this in here for identification purposes. Sometimes you see on the income statement they'll say sales revenue net of the 30,000 refunds, returns, and allowances. And so we might just see it as one line item there. Bottom line is the gross profit. What we call gross profit is the sales revenue minus the cost of those units. So this determines how much money or what's the markup above the cost that we're actually selling these goods for. Gross profit is the starting point up at the top. From there, below gross profit, we have salaries, we have utilities expense, and everything else, depreciation below that. So what happens when a credit memo is issued? What happens next? Well, if I issue a credit memo, okay, so think about it. I've got this now in the accounts receivable. There's that $3 million net of the $30,000, right? So they currently owe me $2.97 million, and that's where am I getting that? I'm getting that as the net right here. 3 million minus the 30,000. It's 2,970. So this is now what the customer owes me. So what's the customer going to do now? Okay, there's different options. One, we can just tell the customer, hey, look, just safely get rid of them, destroy them or dispose of them safely. Get rid of the 300 bad phones. Just, safely. Don't just, throw them in the ocean. Walk with me bad. Safely dispose of the phones. I don't want them. You don't want them. Just get rid of them. Alternatively, we can say, well, just ship us back the 300 bad phones. Ship them back to us, and we'll take a look at them. See, maybe it's just maybe the customer doesn't know how to turn the phone on. Ship them back to us. Maybe they're good. We just need to refurbish them. So that's what happens to the bad phones. What about any new phones? It's possible the customer doesn't want any replacement phones. Maybe they say they're okay with 29,700 units. They say the 29,700 is fine. You don't need to make us whole, as they would say. Replacement phones would make them whole. Alternatively, we could just say, we'll give you 300 good phones, and then you got the plus the 300 units. In that case, that would make them whole. They need 30,000 units. I'll ship you 300 new good phones automatically, just to make them happy. So scenario one, let's assume the bad phones are tossed and there's no new phones sent. Okay. What happens in this case? It's basically saying that the customer is fine with the 29,700 units they've got, so there's no action needed here. What they owe us is $2,970,000, and we have the sales revenue on this side, the credit of the 3 million. The net sales, this is the debit. The net sales is a 2970 credit. We don't need to do anything else except just wait for them to cut us the check, send us the check for that. So no new phones given. They just get rid of the bad phones. Okay, fair enough. That's one scenario. Scenario number two says they get rid of the bad phones, but I make them whole. I say, here, I'm going to send you 300 good phones. I'll check them myself. When we sell that, when we try to make them whole by sending them the new phones to replace the bad phones, these are replacements. How do we record that journal entry? Well, we want to record it like a new sale. So we're going to debit accounts receivable 300 times the 100 price, $30,000, and we're going to record a credit of a new sales revenue, 30,000. This seems kind of weird, okay? But you can have to look at the T accounts and see how this whole thing plays out. We'll still debit cost of goods sold. That's the $60 per unit times the 300 units we're giving them. So inventory is going down by another 18,000 units. So what does this look like? This is kind of crazy. It's almost like we get two sales going on, right? There's the original. That's the original sale. This is what we see from up above, another 30,000. It's like a new transaction. So in this case, it looks like we're selling them 3,030,000 in sales revenue. Okay, but remember, we still have that return that credit memo. We still have that 30,000 debit, and we're also doing a sale of new phones. So we have not just the original 1.8 million of cost of goods sold. We have a new 1.8 million or 18,000 in cost of goods sold. A lot of different things going on. The thing about accounting that drives people nuts is you have to sort of build the story up. There's a kind of a timeline that's going on here. New accounts receivable. Take a look at this. See if you can kind of get this. First, we sold the $3 million. They owed us $3 million. Then we said, okay, we'll issue you a credit memo. So now you owe us 2.97 million. Then we're issuing them new phones. So it's like back on the books. They owe us now $3 million again. Okay. Kind of like a storyline when you look at these T accounts. Inventory went down by this. It went down by another $18,000. So we're basically just eating the cost at this point. Scenario three, bad phones are given back to us and no new phones are sent. Fortunately, that'll give us a chance to go back and see if these things need to be refurbished. We could put them back in our inventory account. Most companies will set up a work in process inventory account, sort of like, you're going to hate this, quarantine these questionable units that are coming back. We need to investigate why they're not working. Okay, so in this case, sometimes you're debiting inventory to put them back. Other times you just use a separate inventory account to keep track of them separately, put them in their own little corner space in the warehouse. That's the asset. We're bringing the asset back into our warehouse and we're reducing crediting cost of goods sold. This is effectively reduces our expenses because we're bringing those things back. So in this particular case, we're not giving them new phones. So they still just owe us 2.97 million. Okay. Net revenue is 2.97 million. And in this case, we're going to go ahead and reduce our cost of goods sold by 18,000. These are the returned goods. And these are the quarantine. This is the quarantine inventory. Okay. I want to keep this. These are the good ones. I want to keep the good inventories in their own T account. These are the questionable inventory. Like, what's going on with this? Once these things are looked at, and maybe it's just that somebody didn't know how to turn them on, whatever, we can later transfer them back into the inventory account once they pass a quarantine inspection. Scenario 4, bad phones are shipped back, new phones are sent. So this is like a very complicated sort of set of events. Same journal entries from scenarios 2 and 3. We want to put the bad phones into a separate inventory account. So this little number 1 right here, this little superscript 1 here, what you see us doing is there is the debit, 18,000, credit, 18,000. That was what we saw in the previous journal entry for scenario 3. Then we want to record a separate new sale of 300 phones. This is from scenario number 2. So in that case, we're just debiting accounts receivable, crediting new sales revenue, debiting the cost of goods sold, crediting the inventory. So it's a combination essentially of scenarios 2 and 3 we're seeing here. Estimating sales refunds. Let me actually go back here for a second before I talk about this one. What's the overall effect that we see here on the sales revenue side? Okay, sales revenue, the raw sales revenue numbers, right? We agree it's $3,030,000. Okay, that's what we see in the T account. Okay, there is this sales refunds, returns, and allowances balance. It's an offsetting 30,000. Okay, that's the debit balance right there. So what is the net sales? It's $3 million. That's the original, that's not 3 million million. $3 million, that's like the original sales agreement. They were given 30,000 units, 300 were crap. We gave them another 300 to replace them. So they still owe us the full $3 million. Essentially, this represents, we shipped them 30,000 originally units. They sent us back 300. We sent them another 300 units. Okay. So overall, how many good units does the customer have? 30,000 units. Okay. There was some drama in between, granted, but overall, they got 30,000 units. They owe us $3 million in total. Is that what we see on the asset side? It is. Over here, you see the 3 million, subtract 30, add 30, $3 million. They owe us 3 million. Net sales revenue, 3 million. Debit accounts receivable, $3 million. That makes sense. But think about the expense side of things now. Here we're saying that, oh, there was a little bit of drama here. There was the cost of goods sold, right? When we look at this, 1.8, reduce it by 18,000, add 18,000. What's the overall cost of goods sold in this case? It's $1.8 million, right? And what does that represent? Well, initially it was $1.8 million, right? Then we reduced it by 18,000, right? For these are the units that were shipped back, and we gave them another 18,000, okay? So these are all in dollars. So that's how we got the 1.8 million there. So overall, the customer has 30,000 units. Those 30,000 units, under the price of $100 per unit, it's $3 million. Under a cost, it's 60. 60 times the 30,000 units is $1.8 million. So even though from an accounting perspective, we need to keep track of all these different activities. But at the end of the day, we need to take a step back and say, does the income statement represent the net effect of all this drama? The answer is yes. We're going to show overall that our gross profit in this case is 1,200,123. Overall, gross profit, that's how much we made. Inventory, in this case, it went down 1.8. We brought 18,000 back. We gave another 18,000. So overall inventory decreased by 1.8 million. Accounts receivable increased overall $3 million. So all this, the point I'm trying to bring out here is like there's a lot of different movement, but overall everything works out. Okay. We as accountants have to keep track of all these things because what these different boxes represent are different transactions, different events. And accounting is the language of business. We're not saying, dear diary, we shipped 30,000 units at $100 a piece, $60 per cost. We're saying debit this, credit that, debit this, credit that. Goods are shipped back. Dear diary, 300 goods were shipped back. Debit this, credit that. Accounting is the translation from English, what's happening in English, to what we need to see in the financial records. Key thing you need to realize though, and granted sales returns and allowances that will happen. We live in the real world, so in actuality, we want to, if we know that historically we experience some amount of returns, we need to make an estimate. We should be recording an estimated amount of sales returns and allowances, given that we know we live in the real world. So recall the initial transaction where we sold the 3 million. Cost of goods sold was 1.8 million. This is the original transaction. Once we do that, immediately after we record that, we need to come up with an estimate of how many units we think might come back. That might come back. It's a guess because we live in the real world. We need to make this estimate. So if we expect, say, 450 phones or about 1.5% will be returned based on some sort of historical statistics, some sort of historical statistical analysis. We come up with this. We say, maybe 1.5 might be bad. We don't know necessarily right now at this point in time, but we're making an educated guess. Because the company expects to give the customers a refund, it should record the refund as a liability right now because we live in a real world where things will happen because in the past they have happened. So down below, immediately after, so right after, immediately after recording the sale, we then have to make another journal entry where we record a debit to sales returns and allowances. This is a key thing to keep in mind. We're going to record that right now. This is a guess, I'm making a guess here. Debit sales returns and allowances. Even though it has not happened yet, we need to debit that account for what we expect to have returned to us. It looks like what we're doing here is we're saying 45,000 has come back to us. It hasn't yet, right? We're just making a guess. Therefore, we're not crediting. We may be doing the debit to sales returns and allowances, but we're not crediting accounts receivable, right? Not accounts receivable. Because in this case, we don't know if this will actually happen. If it did happen, we would credit accounts receivable, indicating that we've issued a credit memo. But because it might not happen, we'll just record this credit as a liability, sales refunds payable, while still showing a debit to the contra revenue account of 45. What do we debit from the cost of goods sold standpoint? We can go ahead and credit cost of goods sold as if it has happened. Just like what we did up above, we made a guess, we're recording it as if, even though it didn't. So we're going to go ahead and credit cost of goods sold for the amount we need to reduce. And that's the 1.5% of the cost of goods sold. In this case, the debit to inventory returns, that account, sometimes you see that on the balance sheet as an estimated amount that we expect to have returned to us. Sometimes it's set up as a it can be set up as a contra equity account. So for right now, inventory returns are amounts that we expect. These are this kind of like an inventory receivable. I know this seems kind of weird, this concept here, but if we expect to have inventory returned to us, why not set it up as an asset, indicating how much we expect to come back to us. So think about this as just an inventory receivable account. If, as what we saw, it wasn't we expected 450 in phones, but what if only 300 came back? We will process them as they come in. We will debit the refunds payable account. That will go down for the 30,000. We will then credit accounts receivable saying you no longer owe us $30,000. We know that those phones are bad. We'll quarantine the work in process account, 18,000. And in this case, the inventory returns, aka the inventory receivable. Think about this again like inventory receivable. Okay, that account is going down in this case. So the ledger postings will overall, it'll kind of look like what we expected here. The 45,000 liability, 30,000 has actually come back in. So we still expect another $15,000 of refunds potentially. But everything else is processed as we expected them to. There's the 18,000 of inventory, the quarantined, right? Wear your mask inventory, right? Put that into quarantine, reduce the inventory receivable account by the 18. We still expect potentially um, the difference in this case. We still expect 9,000. It's the debit balance after all is said and done. I believe that's the case. Yeah, 9,000 inventory to be returned. Okay. That's how we deal with estimated estimations of inventory that will come back to us. And again, the reason why we have to do that is because we live in the real world. So those are all the notes I have. That's a lot of information, but it just emphasizes the fact you need to be reading your book before you come to class. So make sure that if you haven't read your book and all this looks confusing, go back and read your book. See how they're talking about it. I'm showing you the process of how it actually works, but you need to have like some sort of idea about what I'm talking about before you come into these lectures. This is a long lecture for sure. We had some stuff we had to take care of. So just make sure that you're staying safe out there. You're keeping up as we go through this. We got the exam coming up. Let me know, please let me know if you have any questions or concerns about